Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. It's Fed Day. Traders are pricing in a quarter-point rate cut, so the focus will be on what the central bank's dot plot says about the rate path ahead. Fresh UK inflation data crossing the terminal will bring you the latest CPI readings after wages came in hot. All this ahead of the BOE rate decision tomorrow. Plus, Nissan shares soar on a report of merger talks with Honda, potentially creating a new Japanese car giant.
In the meantime, quick check on these markets. Slight moves to the upside in futures, but all the action in the bond and the FX market. You're looking at 438 on the 10-year yield ahead of Fed Day, and of course, perhaps getting a little bit of its tune from what's going on in the gilt market as well. Eurodollar at a 105, cable still trading and whipsawing. Actually, we'll get to that in a moment. The countdown to the opening trade starts right now.
Wednesday the 18th, good morning. Is today a day where we reprice central banks around the world? Of course, the Fed coming a little bit later. The Bank of England firmly in focus right now. Yesterday, the wage data certainly upset the market. The expectation is the bank will do less. Today's inflation data looks pretty much in line with what the markets were anticipating. I'm not sure this changes very much.
Yes, absolutely. I feel like the session chart of the pound right now looks like a lie detector test, guys.
Yes.
The market really not sure what to do with this. It's sort of oscillating around where it was before the data hit. Obviously, people were nervous given the real blowout wages number that we got yesterday. So the inflation print year on year coming in at 2.6%, as you say, Guy, entirely in line with expectations, as is the CPI month on month. The core number coming in just a touch below estimates, as is the services CPI. And that could be interesting because a lot of people yesterday were saying, OK, so the wages data is high. That does spill into services. So we'll see if that's something that sticks with the market. But the pound pretty unchanged as a result.
So I think the 5.1, 5.0, very marginal. So Bloomberg Economics had a 5.0 and a lot of people have. I think there's just a kind of slight skew towards 5.1 on that services line. So I think pretty much in line with expectations. I'm not sure how soft that actually is. As you say, the pound is down slightly, ever so slightly now on the session after spiking a little bit higher. The real move came yesterday in terms of what we saw yesterday. That was when we got the wage data. The wage data seems to have been the catalyst for the biggest change. The Bank of England expected to do not very much going forward from here, a bit like the Fed in so many ways.
I want to also add that I think what I'm waiting for is what changes on the BOE pricing, because off that data, we talked about the pound move as well. We went from 3 rate cuts priced into 2025 to 2 rate cuts, and that showed up more in the gilt market than it did in the FX market.
Yeah, absolutely. The change in that expectation around that third rate cut yesterday, Chrissy, went from 90% before the data hit to 20%. So we did remove the expectation, essentially, of that third rate cut from the Bank of England, and it definitely showed up in gilt markets. The gilt spread over bunds, and I know, Guy, you were looking at this, wider to 229 basis points, and that is the highest level it's been since 1990, since, German reunification and things of that nature were in the works.
So the bank's got a real problem now, though, doesn't it? Because the growth data is not very good. And that's the real issue around all of this, is that the UK feels increasingly stagflationary. Very sticky inflation data. And yes, you can argue at the margin around today's numbers. But the growth data is quite weak. Wages continue to be fairly strong. This is not a great combination if you are looking at an economy like the UK. And you do wonder, ultimately, what resolves it. The fiscal story seems to be slowing us down a little bit. Yes. Monetary policy, I don't know how it's going to manage the expansion, though, that we're seeing in terms of where money is going to be spent. So I think it's a really difficult one for the bank to manage.
Might the bank be hoping that it catches the opposite of a cold from the United States across the Atlantic? If the growth story there is as resilient as we've seen it of late, might that be something that adds a positive? Maybe the Fed very much on the agenda today.
But the Fed is, in some ways, in the same boat as the Bank of England is, i.e. we are backing away from rate cuts rather than kind of accelerating that move, which the ECB feels like it's in at the moment. So do we go from 4 to 3 in terms of the dot plot today? Is that the message that the Fed is going to ultimately be delivering it? There is a downside risk that you could go from 4 to 2, and if we're going to 2, you'd have to imply that would maybe imply that some members are thinking about 1 next year, and that's quite a big revision. It's interesting that the swaps market is actually maybe taking a different view on this. So the market is again really undecided as to what is happening here. It's a bit like the Bank of England, really hard to read.
It is, and I think it also depends on where the inflation is coming from, right? Because if you compare it to the Bank of England, so much of the inflation starting, at least forecasted to be ticking up from the goods part instead of the services piece, which has been the driver lately.
Yep.
If you look at the U.S. data, it's been a completely different dynamic where it is largely services driven. It's things like medical costs. It's things like teachers, for example, transportation costs. It's not necessarily goods inflation, and that's the game changer from a result of Trump tariffs or supply chains or whatever.
Right, and so mentioning Trump takes us to the big unknown, doesn't it? In these dot plots, you know, to what extent are those the FOMC members factoring in their thinking around the Fed, around tariffs, around immigration, around all of that policy? What level of clarity do they need on that to be able to factor it in? Because I imagine they don't have that right now.
It's a really difficult one. And it's rippling it. How does the dollar react? The dollar is going to be the story today, I think, which takes us on to Brazil, you could argue. Yeah,
the ripple effect in the EM space is really interesting here because it is suddenly showing up in a lot of EM exposure for a lot of folks. And then you add in the Brazil piece as well. So I'll start off with just saying that we are in the middle, and you flagged this earlier in the week as well, in the middle of kind of a freak-out moment for Brazil. They're trying to rein in a deficit. They're trying to rein in some real currency volatility. I'm going to take the big picture effect here first and talk about how this relates to the Mexican peso, because in so many portfolios, when you want the EM exposure, specifically in Latin America or specifically in that part of the world, you choose between the Mexican peso and the Brazilian real. And already we know the peso has seen quite a bit of pressure off of the Trump trade, et cetera.
Yep.
And now the Brazilian real is even weaker relative to that. You can see that on your chart this morning. That shows just how much pain the Brazilian real is in.
And so the central bank is forced to defend the currency, even though this is a fiscal problem, and that seems to be what a lot of the analysts are saying. And in terms of the gravity of this, Vontobel saying Brazil is sell first, ask questions later. Credit Agricole saying that investors are just throwing in the towel.
But all these banks had really positive call, not these banks specifically, but many banks had a very positive call on Brazil until very recently. This has happened quite quickly. What is interesting about this, though, is that the Brazilian economy is not doing that badly. In fact, that's almost the problem here, is that it's doing very well, but the fiscal is in danger of pushing the economy too far, too fast.
Yeah.
That is what needs reining back in.
And in fact, globally, unemployment is not the story, is it? When we're worrying about economies and where they're going, they're often dealing with tight labour markets and inflation pressures, as opposed to what you would normally expect in a sort of time of crisis to be talking about job losses.
That's why a 70 billion real cutting plan actually doesn't sound too far from what you're seeing in the likes of France, for example, or the United States, where you can have the austerity and the economy can digest it.
We've got a lot going on in Europe. We should probably refocus our attention back on that as Kriti points us in that direction. Let's talk about some of the guests we've got coming up. Marco Buti, former Chief of Staff to the European Economic and Monetary Affairs Commissioner Paolo Gentiloni, is going to be joining us. Great take, inside take on what is actually happening at the heart of Europe. Lucy Baldwin, Global Head of Research at Citi, is going to be joining us a little later. Ariel Houzon Dumutier, Director of Luxury Equity Research at HSBC. Is now the time to be getting back into luxury? Actually, is all the bad news in that space? Are we going to see a recovery next year? We'll debate that a little bit later on.
Yeah, of course, as we await also the Fed rate decision. That's going to be a big one. That coming up at 7 p.m. UK time. The presser about 30 minutes later, about 7:30 p.m. UK time. I think that's past our bedtime, but we're going to watch it anyway. We're going to tune into Bloomberg TV. We'll have full coverage right here. And then I feel like there is a earnings story that maybe isn't getting that much attention. Micron reporting after the U.S. bell today. And that, of course, in the face of the massive moves you're seeing in Broadcom as well and some of the other chip names over in the States. We'll see if that shows up in Micron as well.
What else do you need to know this morning? Let's run you through some of the other news. Luigi Mangione has been indicted in New York on first-degree murder charges for the shooting of United Group executive Brian Thompson. Prosecutors elevated the case to a first-degree murder charge, a charge normally reserved for the killing of a police officer or terrorism, for example. Prosecutors say there are indications that Mangione may now drop his objections to extradition from Pennsylvania. He faces life in prison without parole if convicted. Credit Agricole has appointed Olivier Gavalda as its new CEO, taking over from next May. He is currently deputy CEO and has been with the lender his entire career. Meanwhile, Credit Agricole is amongst 7 French lenders downgraded by Moody's yesterday after the rating agency lowers its sovereign outlook. Moody's says France's public finances will be substantially weakened over the coming years, with political fragmentation impeding meaningful fiscal consolidation. And shares in Nissan have surged the most in 5 decades on hopes that a potential tie-up with Honda will save the Japanese automaker from a financial crisis. Honda is considering several options, including a merger with Nissan, a capital tie-up, or the establishment of a holding company. This feels very familiar for us Europeans. Challenges within the car space. Honda, in some ways, looks like the stronger of the party, but the real story in Japan is the strength of Toyota, which is huge and has made the right bets, i.e. it's gone for the hybrid solution rather than the EV solution, which so many Europeans have kind of sort of leapfrogged, maybe to their cost.
Yes, indeed. And so it does raise questions about how other geographies do compete with the likes of Tesla and the Chinese manufacturers.
Yep.
And that's a conversation we keep having here in Europe. It's interesting because we've quoted people familiar with the situation talking about what's going on here. But Honda did confirm that they are talking about a merger or a capital tie-up or creating a holding company with somebody. So it does seem as if there's still more to develop on this story. And, of course, we know that the Japanese automakers have reached into Europe with their partnerships over years.
Yeah, I think the added piece to this is how does Foxconn fit into the picture, given that they've now announced their a potential stake, or they're in talks to, at least according to reports. That's a chip company. They assemble smartphones.
And cars are chips on wheels these days, aren't they?
Some cars are. Yeah. It's a fascinating one. How does that even fit into their business?
Well, clearly they want to get into a different business, and maybe they see that as an opportunity.
But Apple tried that, and Foxconn and Apple are linked to a large degree, aren't they? Yeah. And Apple tried that and had to back away from that plan.
Given the strength of the Chinese manufacturers, why would you want to do that? Given the strength of companies like BYD and the lead they're beginning to generate in terms of the software around these cars, why would you want to get in and compete with that? I don't know. It's that huge challenge, I would have thought, to make that work.
But I also wonder how much pushback they're going to get from kind of regulatory standpoint. Even within there's a question of consolidation within Japan, and then there's a question of outside investors. And you've already seen that, for example, between the United States and Japan in the Nippon Steel deal. You've seen this in other cross-consolidation stories here in Europe where you don't want that. I wonder how friendly that offer actually is from Foxconn, if it indeed comes to fruition.
Yeah, I wonder if consolidation, well, leaving Foxconn out, consolidation within Japan might be easier to get done.
Yeah, it does feel that feels like the kind of the secondary story to the story surrounding the two Japanese car makers, which are basically trying to compete with Toyota
and possibly Mitsubishi in the mix as well.
Well, there's all the kind of the minor ones. There's this kind of constellation of smaller manufacturers, Suzuki, etc., that exist around these companies, and effectively going to end up with two large centres of gravity within the Japanese automaking space. But how that forms, I think, is yet to be fully decided.
And they'll all still be smaller than Tesla. So there we go. It is 12 minutes past 7 here in London. Let us tell you what else is coming up on the programme. Germany's Conservative candidate for Chancellor, Friedrich Merz, proposes cutting 100 billion euros from migration spending and social aid to try to fix the country's finances. That's his pitch ahead of the German election. We'll go live to Berlin as that election campaign continues to develop. Plus, Bank of America CEO Brian Moynihan tells Bloomberg that regulators need to reassess and relax rules for lenders. We'll bring you more of that interview throughout the show. Up next, we'll be speaking to Chris Wiley, Chief Investment Officer at Connor Broadley. We'll get his perspective ahead of the Fed, ahead of the Bank of England. If you have any questions and you want to get involved in these conversations at all, IB plus BBTV Go. That is the function to use on the Bloomberg terminal. This is Bloomberg.
But I think they need to bring it down a little bit. They just have to be more careful because the economy is stronger than we thought 3 months ago, 6 months ago, but it still has potential weaknesses. You and I haven't even talked about what's going on outside the United States that could affect the United States. Not tariff stuff, but wars. You know, what happened in the Middle East this the week, what happened in Korea, what's happened in Germany. All these political changes could impact the United States.
And, of course, Bank of America's CEO Brian Moynihan, speaking to Bloomberg within the last few hours, talking about the Fed, talking about the risks. There are plenty. The Fed has got a lot to think about. Let's get the details of what we should expect a little bit later on from Jay Powell & Co. Valerie's here with the details.
Guy, it's the last Federal Reserve rate decision of 2024. We have seemed to lock in a 25 basis point rate reduction, taking the federal funds rate to 4.5%. What isn't locked in, though, is their guidance for next year. We get that infamous dot plot. Will it signal 2 cuts ahead for 2025, or will it signal 3? Lastly, we'll be very much paying attention to Powell's tone in the press conference. He's unlikely to give any calendar guidance of when the Fed expects to pause rates, but perhaps if he flags flags a need for caution, a need to proceed gradually. His language around that would get the market speculating it could come as early as January. Here is the Fed's infamous dot plot. The market reaction will hinge on the 2025 projection. The last projection in September penciled in 4 cuts for 2025. The market is currently pricing in between 2 and 3. If we do get a Fed dot plot that shows just 2 cuts penciled in for next year, that would be a hawkish surprise. Maybe it could dent that equity market rally into year-end and maybe spur another leg higher in the Bloomberg Dollar Index. We've seen the Bloomberg Dollar be very close to a year-to-date highs. Perhaps a hawkish Fed, either in that dot plot or in the press conference following, could push the dollar higher and dent the equity market rally into December.
Valerie, great stuff. Thank you very much indeed. Chris Wiley, Chief Investment Officer at Connor Broadley, joining us around the table this morning. Nice to see you. In terms of what we're thinking about going forward from here, as you think about how to invest into 2025, what's going to be the most important factor, the Fed or Trump?
Right now, clearly, it's the Fed. I think we, like everyone else, is putting the whole Trump factor into the, pending tray, waiting to see what actually materialises there. So right now, it is the Fed. It's all the things we've just been discussing. We are into that interesting phase now, having for so long been through this interest rate cycle where it was all about where's the peak going to be and when are the cuts going to come. But for the past 18 months, the confidence has been that we were heading into cuts. We've had that following wind from that. But we're now into that interesting phase where we are finding that pathway to a pause. I think that that's
the market keeps getting it wrong, though. At every turn, we seem to have called the Fed wrong. We seem to have called the economy wrong. The upside surprises have kept on coming on the economic data, as a result of which the Fed has had to be much more cautious. Does that continue? Yeah.
I mean, the market's called the Fed wrong because, frankly, the Fed has called it wrong itself. And I think there is a risk. I mean, let's back away and just really, it's not that complicated when you back away and just look at the data.
With
and
hindsight.
The fact is, even now, right? So inflation really stopped falling quite some time ago. So we're still talking, this language about being in this disinflationary environment. But if you just back away and look at it, then you can see that, the evidence very firmly points to the fact that inflation has bottomed out 2.5% to 3%, more like 2.5% to 3% in the US. And against that backdrop, the Fed is going to have to move away from further progressive rate cuts. And then you get into this debate about what is the right level of interest rate, starting to deconstruct the interest rate. And we're into kind of unknown territory in the sense that the really big question behind this is what interest rate regime are we in now? Are we still in the post-financial crisis range of interest rates, in which case you deconstruct this interest rate and you come up with what the Fed has been talking, which is the neutral rate is somewhere between 2.5% and 3%, or has the world changed and we're going back to the pre-financial crisis range, in which case real interest rates of 2% are nothing unusual. And therefore there's really not much call for further rate cuts.
OK, so that's interesting. So that gives us a lens through which to assess how many more rate cuts we get. If we assume that we get few rate cuts from here, then, Chris, what does that do to your investment strategy? What are you watching, what are you looking to lean more into in 2025 if we're not going to get that many rate cuts?
Yeah, so I think if we work on that assumption that we're finding our way to a pause. I mean, the first thing, I suppose, is still to, we've got to tick that box to say that it is a pause, it's a rate cut or two and then a pause, with the predispositions still to further cuts, rather than the other way round. Because if we get that pivot, which is suddenly that, actually, it's an each-way bet even, that it could be up or down, then that's much more problematic. But let's assume that, right now, we're just losing the fair wind of the expectation of further rate cuts, but we're probably still in a slow rate-cutting cycle. But I think that takes a bit of digesting by markets, but it's still OK, it's still positive. We can still look at that playbook as to what sectors do well in slow rate-cutting cycles, and it's reasonably encouraging, and what the general implications are for markets in slow rate-cutting cycles. So if that continues to be the narrative, then I think we can look at those sorts of sectors. We also need to look, of course, at earnings momentum,
Sure.
and as a driver.
Thinking about the assumption you made, though, there, that we're on a pathway to a pause, we're still in this rate-cutting cycle, even if it results in a pause, rather than suddenly thinking about each-way bets on whether we get a hike or not. I mean, what would it take from President-elect Trump for the market to make that mental leap that, oh, we're actually closer to hiking than we thought?
Yes, well, you can see why the Fed really, really, really doesn't want to bring into frame, the Trump policy question at the moment, for two reasons. First of all, clearly, like the rest of us, they don't really know what the policy manifestation will be. But then, actually, the next question they're going to have, if we look at tariffs, well, then you've got the question, are tariffs inflationary or deflationary? Effectively, they're a consumer tax. And there's quite a strong argument to say that they behave a bit like an increase in oil prices, which is short-term inflationary as it feeds into the price index, but long-term deflationary because it undermines discretionary consumer spending. So there are two very good reasons why the Fed doesn't want to go at that moment, because even if it knew the answer to the first, I'm not sure it really knows the answer to the second either.
In anticipation of some of those potential inflationary prospects off of Trump tariffs or a second iteration of tariffs, the cost of goods is still going up. And I think that feeds this kind of inflationary impulse in 2025 that we're going to get that tick. But it's not necessarily just hooked to the tariffs. I mean, that may be where the bulk of it comes from eventually. But you're already seeing the cost of goods increase. Is that something you trade on? Is that something you price into a portfolio as of right now?
It's priced in, in the totality in terms of the balance of risk for this interest rate outlook, which I've mentioned. You're absolutely right. I think we've had this big win, which has been surprising but welcome, which is goods price. We've had goods price deflation, and we're just losing the benefit of that now. And of course, it's therefore revealing the service sector inflation. And actually, commodity prices look as if they're stabilising. There's probably a slight likelihood of them pushing higher than lower from here. Then services, at least in the US, there's a little bit of hope, I would say, on the service sector side. Unlike the UK, I would caution, that service sector inflation can continue to moderate because of the dynamics in the housing market.
So regardless of what side of the Atlantic you're on, what's the hedge against inflation? It used to be commodities, or it used to be gold. What's the hedge against inflation?
Yeah. Well, I still think, for us, we've been almost entirely in Treasury inflation-protected securities as our, weapon of choice on government bonds, and staying short maturity because of the uncertainty. We think, probably that uncertainty on inflation continues to be underpriced in the market, and that certainly seems to be the case in break-even inflation. And I still think gold is worth a shout as well.
All right.
Kriti.
Okay. Well, I was gonna give you another shot to ask another question. We could have this conversation all day. Chris Wiley, we'll leave it there. Chief Investment Officer at Connor Broadley. We thank you so much. I thought it was really interesting that he's talking about using Treasury inflation-protected kind of securities instead of gold, instead of kind of the commodity aspect.
Tips and gold.
Despite the commodity, I feel like the commodity basket was the trade du jour of 2021. So if
the problem is, though, the
commodity
market gets influenced by what is happening with China. Sure. That's where the greatest impact seems to be felt at the moment in terms of what is happening with the major metals complexes. You do seem to see that trade happening there. It's interesting that in the UK, it's the services side that is seen as being problematic, despite the fact that actually that's where the data this morning looked okay.
Yeah.
I say okay. I could still very, very elevated.
Yeah.
But
okay
that's where,
at 5.
Okay at 5. Yeah, exactly.
The roadmap should be interesting in terms of how that all squares away with governments that maybe don't have the money to actually address some of those inflationary costs, subsidies, et cetera, which we did have the last time around. We're going to dive into that dynamic coming up next as political uncertainty grips the EU's two largest economies. We're going to discuss it with Marco Buti, former chief of staff to Paolo Gentiloni. That conversation next. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes until we get that opening trade for Europe. The futures picture then looks a little brighter than perhaps recent days. We are expecting to go maybe a touch higher, but not much. Flat, in fact. I'm slightly overselling that, aren't I? US futures looking similarly slightly higher. E-mini's just up a 0.1% or two. Yesterday, the S&P did actually rally towards the end of the trading day, so perhaps I was thinking that maybe that would influence the start of trade, not by much. Waiting for the Fed, of course. That's going to be the big news event of the day, and that will come after the European trading day closes out. Let's have a quick look at where we are on bond markets. We continue to see a little bit of upward momentum in that French yield. 3.03 is where we trade. So slowly, as we get towards the end of the year, we are seeing a little bit of a move higher in that yield. And in fact, in yields more broadly, that seems to have been a trend of the last week or so. Let us put European politics front and centre. Germany's Conservative candidate for Chancellor, Friedrich Merz, has proposed cutting 100 billion euros from migration spending and social aid in an effort to fix the country's finances. The CDU leader is currently leading polls ahead of February's elections. Let's get more from Bloomberg's Germany bureau chief, Christoph Rauwald, who joins us now. Christoph, very nice to have you with us on the programme. So tell us, that's just one of the things we heard from Friedrich Merz yesterday. What more do we know about the platform that Friedrich Merz wants to stand on?
Yeah, he basically mapped out some initial ideas of his election program that will basically dominate his election campaign in coming weeks. One aspect that you mentioned already is basically some pretty significant cutbacks when it comes to spending on basically cost for social welfare, for accommodating immigrants into Germany. But he also talked a fair bit about the need for investments. And one thing that he made very clear is actually that in order to drive the modernization of the German economy, to overcome the current struggles, that will actually require very significant investments. And he also made it very clear that any sort of significant economic recovery will actually take some time.
How big a shift is this going to be from Scholz, what we could see from Merz?
I think it's one of the sort of starkest sort of differences, I think, between the two main candidates who run for the chancellery in the snap election in February. Scholz has made it very clear that he does not want to cut back any spending on social welfare, which has been a pretty significant burden for German taxpayers in the past, and he has faced a fair amount of criticism for that as well. Merz is definitely going into the different direction there to some degree, and he really wants to make this one of his core messages during his election campaign.
We'll leave it there. Christoph, thank you very much indeed. Christoph Rauwald joining us on What Next for Germany. Talking of what next for Germany, let's talk about Germany's banking sector. UniCredit apparently raising its stake in Commerzbank to around 28%. I wonder what the German finance minister thinks about that. The current German finance minister, the potentially new German finance minister, whoever that may be.
Yes, whoever that might be come February or so. It's interesting. They're doing this with financial instruments again. So remember, they took that stake of just below 10%. They're asking if they can go higher than that. But in the meantime, they're using all kinds of financial instruments to get them to a place where they have that exposure. So they're up at 28% now. They've submitted those necessary regulatory filings. They're saying this economic exposure is almost fully hedged. And UniCredit has talked about this as an investment up to this point, an investment that might turn into a bigger takeover story, but it might not. And we know, as you say, that the German government has not been keen on that idea and has stopped selling stakes in Commerzbank as a result.
And speaking of its stakes, it's also saying that this stake does not impact the one in Banco BPM's bid as well. And we know that last night, Banco BPM had kind of solicited the help of the Italian regulator, saying this is not a fair price.
You've also got an Agricole story element to this as well, where we've now got a new CEO potentially coming in. How does Agricole potentially pursue further interactions with BPM? I think is an open question as well. Could UniCredit pursue both of these at the same? Is that possible?
Cross-border M&A in the banking sector, banking union.
Germany, Italy,
and France.
Kind of with UniCredit at the same time.
How does UniCredit have this much money? Is my question. That they're on this buying spree.
Well, clearly Ochel has decided that he needs to do some sort of consolidation. Now is the right moment to do that. He's clearly facing significant amounts of pushback. Does the determining factor of which way he ultimately looks come down to politics.
Yeah.
Is it easier to do the Italian trade or is it easier to do the German trade?
It's a big vote on the German economy as well. They're even saying in the statement it reflects a belief in Germany, its businesses and its communities at a time when we are questioning the German model
Sick man.
quite a lot, you know, the auto sector and beyond. We started the week talking a lot about that, the weakness in the German economic model.
Yeah, and you see it in Germany, you see it in Italy as well, where some of these kind of previously government-owned stakes need to be offloaded because they need that fiscal help. I feel like that's where this conversation is going next. Let's bring in a true expert who I'm sure is dealing with all of these issues and has kind of first-hand exposure to it. Marco Buti joins the program. He holds the Tommaso Padoa Schioppo Chair at the European University Institute. He's also Chief of Staff to the European Economy Commissioner, Paolo Gentiloni. Marco, pleasure to have you on the program. You picked the perfect day to join us, so we appreciate your time. Let's kick it off with this kind of banking consolidation news. And I understand you're coming at it from a Brussels perspective, but one of the key considerations in this conversation is that so many people out of the EU, leaders from across the continent, are talking about banking consolidation. But when we have this movement like this, there's almost a bit of panic. And I'm curious from your perspective what the EU needs to incentivize more of that consolidation that maybe we're seeing a little bit more pushback on right now.
There is pushback because we know that banks are, the quintessential of, in a sense, national sovereignism when it comes to the, to the crunch. So I'm not surprised that there is this pushback, but I think it's absolutely important. And here it is vital that the ECB, the banking supervisor, the European Commission, give a clear sign that one cannot undermine the single market also in banking, because, I mean, at the end of the day, our future very much depends on deepening and broadening the single market.
But what does that require? And is this really just coming at a time where a lot of these kind of fiscal handcuffs are being placed on the governments of Germany, on the governments of Italy as well? I'm curious if in an alternate universe in, say, 1, 2, 3 years' time, where perhaps some of these debt loads are more aggressively brought into line, specifically in the likes of France as well, does that undermine the need to consolidate? How does that work? What does that dynamic look like?
Look, I think there is an issue here which is broader than banking. I mean, if I can summarize it really in a brutal way, France has a problem of public spending, Italy has a problem of productivity, and Germany has a problem of their business model. So let's call it like this. So I think we will need to rethink radically, especially given the forthcoming US administration, the way we conceive the, being together in Europe and driving, a new sustainable growth. So I think consolidation is going to be the name of the game. I think that is important both on the banking side, but also on the general corporate side. I mean, as has been said, we cannot be the only herbivore in a world of carnivores. So I think Europe will have to take its, courage and move across some red lines, also in the articulation of what we do at the national level and what we do at the European level.
Marco, look, if European governments don't like banking consolidation because they worry about it being a reflection of their sovereignty, why are they going to allow actually their sovereignty to be diluted? Haven't we reached peak Europe in terms of the dilution of the sovereignty story?
No, look, I think we will need to, so far, what has prevailed is a very short-term horizon. I mean, I like to say that we have leaders in Europe now at the national level who have a very high discount rate, very high political discount rate, meaning that they are very worried about today, maybe tomorrow, but they are not worried about Europe and the European economy and the European society at large, actually, down the line. So the hope really is with the clarification on the German side. I think it is an opportunity to have a more stable, forward-looking government with the elections in the end of February, and hopefully also France would find a way out of this current political mess. So, I mean, we need to have forward-looking governments, and always when we have crossed red lines in the past, it has been a combination of Berlin, Paris, and Brussels. You know, think about the creation of the euro back at the end of the 1990s, but also closer to us, next generation EU and the reforms during the pandemic. There we had Angela Merkel who could think about history, Emmanuel Macron who had in front of him just 1.5 terms, and we have Ursula von der Leyen with just being installed as president of the Commission with a Green Deal. So all these leaders had at the time, and thankfully, long-term horizons. We'll need to strive to get back to that, because short-termism is, I think, a big problem when it comes to European affairs.
The problem up until now, though, Marco, is that more Europe has meant more regulation. And many would argue that, therefore, this is what is holding Europe back at the moment. Yes, you've got this interplay between the various governments, but Europe feels like it is over-regulated right now. It is not the freewheeling economy that we see in the United States that is producing tech giant after tech giant, company after company that is capable of competing on the global stage. We don't have that at the moment. How do we get that? How do we make sure that Europe delivers a lower regulatory environment that doesn't stifle growth, that allows these economies to generate the money necessary to pay for all the things that Europe needs? The environmental transition that we need to go through, defending ourselves against external threats, and making sure that we can deliver the welfare in Europe that our populations require. We need the money to do that. We need maybe less regulation to provide the mechanism by which we can pay for it.
Yeah, you're absolutely right. I think over-regulation has been a problem. I mean, typically, and that's my experience in Brussels, teaches me that, is that when we have a problem of money, we double down on regulation. When we have a problem with regulation, we establish some coordination processes on the governance side, who usually make things rather complex. So we have a blueprint now to review regulation. And it is, I mean, we have a double, two reports by two former Italian prime ministers, Enrico Letta on the single market and Mario Draghi on competitiveness. And regulation takes the center place in those blueprints. At the same time, I want to be very clear, I do not think that in Europe we have and we will ever have the stomach for the deregulation type of the US economy. So we will need, I think, lower regulation, but better regulation, and make sure that we carry out this reducing red tape in a more effective manner. But the balance, the equilibrium here in Europe between efficiency and equity is different than that of the United States. So we will have to find our own way. I don't think that we are done. We are, back compared to the US on all sides, or in all technologies.
Yes.
We are certainly lagging behind on the disruptive technology of the Elon Musk type, but on others, take new materials, take the green transition. We are, at the forefront, or at least we have the chance to catch up on that
Yes.
front. But we will need to find the European-specific way to make it politically acceptable.
OK, so Marco, so Europe does it its own way. It needs to be politically acceptable. You've talked about the need for leaders to think about the long term. But how do you square with that with increasingly nationalistic politics?
I think at the end of the day, when you come to you try to pass beyond the ideology of nationalism and sovereignism and think about the actual interest also at the national level, you will see that more Europe, but not more Europe in general, but concrete projects done at the European level. And here one can think what, or European public goods start with defense, for instance, I think is in interest of everyone. So European sovereignty, I think, would be the name of the game. And I think we'll need, again, as I stressed, to cross some red lines also on the budget, on pulling together. We did it with 800 billion with Next Generation EU as a response to COVID, and it worked extremely well. It actually stabilized the markets in a very, very dangerous situation at the time. And I think I can see that in spite of the reticence still due also to electoral messages, but I see that we are making progress on creating the conditions to a new common endeavor. And I think here the trigger point for reasons which are of geopolitical nature is going to be on the defense side.
Marco Buti, we look forward to having that conversation as the months and years roll on. We thank you so much for joining the program. The perfect timing, as we said. The Tommaso Padoa Schioppa Chair at the European University Institute and former Director General for Economic and Financial Affairs at the European Commission. Much more ahead. Stick with us. This is Bloomberg.
Welcome back to the opening trade. 10 minutes just about until we get trading here in Europe, and expectations for the start of trade pretty mixed, actually, fairly flat, maybe a bit of upside on the FTSE 100, but not much else to talk about. US futures flat to positive this hour. Let's, with the Fed in mind, go to our conversation with our Markets Live executive editor, Mark Cudmore, who's with us to talk about the markets in 3 minutes. Mark, we've been distracted by bank consolidation in Europe, the European project. Take us back to the event of the day that's still ahead, which is, of course, the Fed rate decision. What are you watching for? Based on the dots, what do you think could be on the move?
So I think we're going to get, everyone expects a hawkish cut. I think what's going to be most interesting tonight is the fact that the expectation for what the Fed will deliver is just so consensus that it's pretty hard for them to that hawkish cut. When you're reducing rates and yet still trying to hawkish, how does that work, to really over-deliver on expectations? So even though I do expect a hawkish message, I'm not sure the dollar can really push much further higher, especially since positioning's already really long. On the flip side, do you really want to fight the trends at this point of the year? There's no other catalyst now until the new year. So I actually think this Fed won't be a big market mover. Of course, that's when, you don't want to be too complacent. But people are really watching for it, waiting for it, and then we'll switch off. Maybe tomorrow. We've got the BOJ to come as well, though.
Does the dollar continue to appreciate against the Brazilian real?
That's a great question. I have to say, the Brazilian story is very, very worrying. You've got a country which has got overall good growth, extremely attractive real yields. It has got commodities. It has got what the world wants right now. At the moment, it's become a dominant position in ags. It's got metals. It should be a great story. It's got good demographics. But the worry is, it's got a very worrying debt situation, very worrying fiscal situation. And then the comments out recently by Lula saying it's about those high interest rates. That's the real problem. It's not the fiscal side. That is getting people worried that this is going to be a little bit like a Turkey situation. Turkey was the wonderful EM story of the 2000s. It was one of the best EM stories of the 2000s, along with Brazil, actually. And, of course, Turkey completely blew up as an investment and has not recovered for years. People are worried that Brazil is going that way. I find it hard to see, but I understand the nervousness, and it is not yet time to probably buy the dip yet.
So, Mark, if you were searching for yield and you want the juiciest asset while also preparing for a second Trump administration, where do you go?
it's really tough out there. I think that you know, there are some real yields in EM which are looking very attractive. If you are willing to have smaller size and cope with low liquidity, of course, there's still a lot of really attractive yields in Africa, in some of those kind of, you know, more frontier markets rather than emerging markets. But I think even emerging markets offer good yield out there, and many of those stock markets are extremely discounted. The problem is, you don't want to really be going in enthusiastically at this time of year. It's probably a trade for maybe late January, February, after Trump comes in and takes power.
All right, Bloomberg's Markets Live executive editor Mark Cudmore, we thank you so much. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we are expecting to see a gain in Renault shares today following this massive rise that we saw in Nissan overnight on news that they are looking at a potential tie-up with Honda, the car rival. Now, bear in mind that Renault is the largest single holder of Nissan stock, as we can see from the screen here, with a 36% stake. So we are seeing this one called higher on the French exchange today. Then in terms of AstraZeneca, there is a report out in the FT saying the company might see a decline in sales in China. That follows the detainment of several executives in the country. But this issue has already weighed on AstraZeneca's stock over the past few months, down around 20%. But it is one of the favoured stocks on the street, with not a single sell on AstraZeneca, so potentially a bit of downside in this one. Then in the banking space, UniCredit ranking up once again its stake in Commerzbank. Now, the company is reporting a 28% exposure, partly through derivatives, but it is going to fuel further speculation around a potential full takeover. Couple of rating changes to bring to you in the investment space from Bernstein, where they do favour Allianz, downgrading Generali. Meanwhile, in the game space, we've got a downgrade today for Ubisoft. That one could be weaker over in Paris later.
Joe, thank you very much. Joe Easton with a look at some of those stocks that could be on the move, and the sectors will certainly keep across the auto space. Renault in focus then after news of possible consolidation in that industry. Consolidation in the banking industry in focus here in Europe. Andrea Orcel furthering his bet on Germany and on UniCredit, in fact, with use of those derivatives. Will certainly keep that sector in focus. The bigger picture, the bigger macro story, though, very much around the Fed, waiting for that Fed decision later on today. We'll be back with the market open, though. In the meantime, this is Bloomberg.
Good morning. If you're heading out for a long lunch a little bit later on, pre-Christmas, etc., I would maybe start with breakfast. I don't think the European equity market open is going to be very exciting. I think we're basically flat. A little bit of history in terms of where we're going this Wednesday morning. This was the session yesterday. Little bit of a kind of rally, then fade into the close. The US market rallied a little bit into the close as well. I don't think it gives us a particularly clear guide as to where European equities are going to go later on today. But at the get-go, it looks like they're going to be fairly flat. The real story coming out of yesterday was the increasingly narrow nature of the US market story, Kriti.
I feel like it's exciting. The Christmas spirit very much in the futures picture. You're seeing some red, you're seeing some green. I'm wearing green in solidarity with the Christmas spirit. But I think the real underperformance story here is in Italy. And that's interesting given that we are going to see some of that individual stock moves as well. Anna will dive into that in a moment. But broadly, green on the screen, perhaps paring back some of the losses we saw yesterday, Anna.
Your green dress, my red dress. We're either the full sort of Italian complement or we are something very festive. Kriti, let's have a look at some of the individual stock movers and sectors in focus, because here, under the hood, could be where we see some exciting action. UniCredit and Commerzbank certainly in focus as UniCredit increases its holding in Commerzbank to about 28%. This by using further derivatives to make that exposure happen. Renault and other European firms are in focus because they've got exposure to the Japanese car makers Nissan and Honda. There is talk of them talking to each other about some kind of bigger tie-up. So we're certainly watching Renault as they own a 35% stake in Nissan. AstraZeneca also in focus as well. We've seen some reporting elsewhere that talks about whether we might see a sales dip in China because of the arrest of one of their key staff in China, Guy.
So maybe the single stock story is a reason to stick around this morning and not head out for a breakfast. Let's talk about this market open. The opening trade is upon us. This is what you are looking at. I suspect it's going to be a fairly flat story. Here you go. The FTSE 100 delivering an exciting 0.03% to the upside. Nope, can't quite make up its mind. Oh, yeah, we are getting a bit more upside. But nevertheless, I feel like I'm dancing on the head of a pin here. The Stock 600 is delivering also something sensational this morning. The Spanish market is up by nearly nearly 0.1%. Revolutionary. We will wait for the CAC 40. We will wait for the Italian market. We will wait for the DAX and the SMI to deliver their verdicts on what this session is going to look like. But I suspect, despite actually what is a fairly busy news agenda this morning, that equity markets may wait for the Fed a little bit later on. Kriti.
In the meantime, we are seeing kind of a tale of two stories. You are seeing a little bit of a rebound in some of the French individual stocks that have been underperforming in the last couple of days. ASML at the top of that trade. You are seeing a couple of other movers there, but it really does feel like paring back some of the losses we've seen in the French market. Of course, we are still waiting for the full liquidity to show up. But just on my screen, we're seeing the likes of Sanofi, we're seeing the likes of ASML, even LVMH and Shell kind of driving the upside, which again have been the underperformers of the last couple of days. You're also seeing some of the automakers very much in focus. Mercedes-Benz is higher by about 0.9%. We should mention that there are talks happening at Volkswagen at the moment as well. That may be reflected in the Volkswagen shares as we get a little bit more liquidity, Anna.
Yeah, even if we don't seem to be getting very quickly to any kind of resolution of that, we do see autos and parts is the best performing sector this morning. And Volkswagen not doing too badly in the mix. They're up by, well, just 1%. Valeo, some of the other suppliers to the auto industry doing OK. Renault yet to open, though, I should say. And that's where we have that big exposure to the Japanese consolidation story. Energy not doing too badly as well. That sector also up by around 0.4%. In terms of the banking themes, you know, the banking sector overall is entirely flat. But there are really interesting things going on within this sector, aren't there? We're waiting to see, you know, how UniCredit performs. We're waiting to see how Commerzbank performs. I think UniCredit is just down 0.1%. How does Commerzbank perform on the back of this news that UniCredit has increased through derivatives, at least, its stake in that business? We're watching the French banking sector because we've got something we would expect from Moody's downgrading some of the outlooks for those, the performance of some of those banks or their expectations for those banks. So there's a lot to watch in the banking space.
Can I just say that gilt yields have gapped a little lower as well this morning on the back of the inflation.
After the big move yesterday to the upside.
Yeah, precisely. So, but we've not given all of it back. We've given some of it back. So I think the expectation post yesterday that we are going to see a more hawkish Bank of England sticks, despite the fact that actually inflation came in largely in line with expectations and didn't deliver that upside surprise this morning. So we're trading a little bit firmer on gilts after the move yesterday.
And yep, you see it on your screen just there. It's also worth pointing out that we're also getting, as Anna was pointing out, the banking sector, Commerzbank currently halted, I believe. We're waiting for it to start trading. It says volatility interruption on our screen, but you are seeing some of the Italian names that trade lower. I'm seeing UniCredit, I'm seeing Banco BPM and Monte Paschi, all of which have stakes in each other or potential stakes in each other, all trading lower this morning. It speaks to the idea of, do you actually want exposure to the Italian index as a whole in the face of some of this consolidation news? The same theme applies to the likes of Germany and France. Karen Ward, JP Morgan EMEA chief market strategist, joined the show yesterday. And here's what she had to say about that right mix of exposure. Take a listen.
Yes, the U.S. economy is going to do better under Trump, but that is in the price. That is why you're paying 22 times high earnings expectations for the U.S. market and 14 times lower earnings expectations for the European market. We need to have a think about quite how overweight the U.S. you want to be relative to Europe, because if I'm right on some of the policy catalysts coming through in China, in Europe, then maybe that's where the surprise is.
Joining us now is Lucy Baldwin, Global Head of Research over at Citigroup. Lucy, pleasure to have you on the program. We keep talking about this exposure story and whether or not, as we wait for maybe a cyclical uptick or an inflationary uptick, is Europe the right place to be? Your thoughts?
Yeah, absolutely. Well, look, we feel that the US market still does offer a number of attractions. So we would certainly suggest to investors to stay invested, right? There's obviously a lot of policy surprises potentially to come next year in the United States. But what we would say to people is to barbell it and to also have some exposure to Europe, because we do feel that Europe is incredibly unloved, right? It's the big theme at the moment, really, is how much more unloved can Europe possibly get? It's at a 40% discount to the US. It's pretty extreme by any historical standards, that gap between the two markets. And we do think there's a number of catalysts to the points that Karen was raising there. We think potential ceasefire could be an upside catalyst. We think there will be fiscal stimulus coming through from China. And I think that could still be a meaningful upside when it comes through, if that can start to see some short-term impacts. There's also clearly a series of other potential catalysts around maybe trade being more of a negotiating point with Trump 2.0 rather than just a blanket set of tariffs. So I think there's a few things things that could give us hope that Europe is going to see, if not double-digit upside to the market next year, then at least very high single-digit upside, because we do think you are going to see some earnings growth and there is some scope for a re-rating.
Did we just find a Europe bull in the wild?
Maybe she won't go that far.
Endangered species, for sure.
It's certainly a rare one, for sure. But you pointed to a lot of catalysts that are outside of Europe. And you mentioned the fiscal stimulus read-through from China. Is there a prospect of fiscal stimulus from European governments? We've seen that in Italy. Do you see that in other parts of Europe?
Yeah, I think the big hope there is obviously Germany. People expecting to see, around German elections, some sort of hope of a mini-Trump-type situation there where you can have a bit of a regulatory reset, ripping up some red tape, and you can get some fiscal stimulus coming through. We all know that the German consumer could, in theory, go out and spend. It's obviously one of the countries that has got that fiscal capacity. So there is that big hope that Germany might be that catalyst that Europe very much needs.
I love it. In theory, the Germans might go and spend.
I was a consumer analyst guy for many, many years, and it was something we were expecting to see for a long time. So there is always a bit of caution there.
It's always potentially out there, German consumers, if they can actually find time to go shopping. The equity market in the United States, some would argue, is very expensive. If it were to catch a cold, would Europe be a place to hide out, or would Europe suffer more than the United States if the US goes down?
I think it's going to depend on a lot of other factors. So just to sort of take you through how we think about the US, broadly we're expecting to see double-digit earnings growth next year coming through from the US, actually slightly more than we've even seen this year.
Yep.
I think it's going to be hard to hold that multiple because, to your point, versus any sort of historical metrics, we're at pretty much all-time highs, right? So we probably get a bit of a derating, but with sort of up towards maybe even mid-teens earnings growth next year, you can still have some great momentum coming out of that market. You can see broadening in that market beyond the big cap names, because we all know the concentration challenges and risks. And I think thematically, the different policies that will come through will give room to run for different parts of the US equity market that perhaps haven't seen that in the last couple of years, in these last two big bull markets. I think when you sort of put that alongside what we see in Europe, I think really the interesting thing with Europe is there are some really great quality names. We relatively recently upgraded the luxury sector, for example, going back to the China story. So I think if the US equity market catches a cold, it's most likely to be probably on the back of tariffs, right? If you think about the four main streams of policies that are going to come through, taxes, i.e. fiscal, trade, immigration and the sort of regulatory reset, I think the area that's going to be the big risk where you could see sort of negative demand and supply shocks is the trade war. And obviously that is, at the moment, something that people, I think, subscribe less than a sort of 30% chance to seeing very broad tariffs on everything and big retaliation. I think if that were to happen, that's going to be bad news for all equity markets. But for sure, I think Europe would be relatively better insulated than the US, is how I would think about it. So I would try and have a fairly diversified portfolio of equities with some of those really high-quality growth, some value opportunities.
Right.
We've actually, interestingly, at an asset allocation level, suggested to people that Japan is the market to be the most cautious on and to be underweight as the hedge.
And thinking about 2025, sorry, I was distracted, Lucy, because I was thinking about this statement that you made in your research, in your notes, which I thought was really interesting. You say 2025 is all about sequencing of Trump trades.
Yes.
So tell us more about why the sequencing matters.
Well, I think the sequencing is going to matter because potentially a lot of the things that people are very worried about either might not happen because they've got to go through Congress or they're going to take a very long time. So the big debate is whether some of the good stuff comes early or whether it comes late. And again, sort of very broad brush. If you think about those four policy pillars, I think people are obviously very excited about the regulatory reset and about potentially the fiscal support that might come through. Again, we would suggest that's not going to be of huge orders of magnitude. We and most economists haven't meaningfully changed their forecasts for growth here on the back of it. But if those are the two positives, the two sort of negatives that everyone's worrying about in terms of weighing on growth and risks to inflation are obviously the other two, i.e. the trade war and the tariffs and the immigration story. And so I think when you sort of pull all of that together, what you're really going to see there is the sort of net effect of those things playing out is what you've got to watch. And we think that broadly, yes, that will be a little bit more inflation. but it's probably also a little bit more growth.
Yes, OK. And do you worry at all that the market has been quick to price in those positives already, regardless of the timing of the actual announcements in 2025, and has left the negatives to the side because they've said there's too much uncertainty around those?
Yeah, and I think to your point, right, on the sequencing, I think some of those things are going to require going through, getting Congress's support. So some of the major tax-type reforms would come much later. So your risk is that some of the negative stuff happens earlier, right, and that you end up with things via executive order like tariffs happening earlier. So I think that's why people feel the volatility going into next year could be very much higher. But I think there is a reasonable amount, clearly, of optimism priced into the US market, which is why the tariff case is such a sort of curveball wild card. When we look at the US, it is actually our biggest wildcard market overall, which is why it's hard to say definitively, oh, it's all there, it's all in the price. So just to give you a bit of a flavour, in our outlook that we've just published, our US economist has actually stuck to a much more cautious stance on the US. He thinks you could get 125 basis points of cuts in next year because he still feels the labour market is going to loosen substantially at some point. Now, that is a very out of consensus call.
Dot's not likely to show that today, at least.
No,
we'll see.
No.
We'll see a little bit later on. Let's just talk about the breadth of the market. You referenced this a little bit earlier on. The breadth of the market is getting narrower, not broader. And you've also got portfolio managers. I looked at the fund manager survey yesterday. Basically, as long as they can be. I think they're pretty much out of money. Retail is as long as it's ever been. I think it's pretty much out of money. There may be a little bit left in the money market accounts. What is the impetus?
Yeah, who's the incremental?
Where does it come from?
Yeah, look, I think, essentially, to your point, right, you have to have that earnings growth coming through. So ultimately, the call on the broadening has to be that the small mid-cap components of the market start to see upside surprises to growth, right? And you start to see that coming through. And a lot of that goes back to the AI boom and whether you actually see things like, beyond the infrastructure names, beyond big tech, you start to see the rest of that ecosystem where the $1 trillion of capex is getting spent. You start to see the returns coming through and the growth coming through in some of those names. We do think, though, that there are parts of the market, going back to the policy implications of next year and where we're going to go, we do think areas of the market like financials have got further room to run. We'd expect to see increases in capital markets activity, M&A, etc. Deregulation. That, I think, is going to be a big positive for those parts of the market where we'd still see upside. And I think parts of the energy complex as well, where you'll see that deregulation story panning out, as well as the consumer. Never bet against the US consumer, Guy. That's always
the German consumer's fair game, but the US consumer, not so much.
Absolutely.
Nice to see you.
Great to see
Christmas.
you too. Merry
Thank
Christmas.
you very much. Lucy Baldwin, Global Head of Research, joining us from Citi. Call 6 looks like this. Let's take a look at some of those luxury names and see how they are performing today. A little on the downside, but not by much. Ferrari and LVMH both a bit soft. Tech's having a slightly better day. I'm going to include Schneider in there. Nestle continues to push lower. Novo down by 0.9%. Single stock stories. Let's get more details on what is happening in banking, etc., etc. Joe Easton's here with the details.
So we are seeing a big gain first in the auto space for Renault over in Paris. It is the best performing stock on the entire stocks Europe 600 today, given that massive jump we saw overnight in the share price for Nissan in Japan following news of that tie-up with Honda. Lots of moving parts on that one. So the stock gaining, remember, a 36% stake, really beneficial for Renault today. Then in terms of the banks, another sector that's got a lot to keep track of. There's a move higher in Commerzbank. News breaking moments ago, UniCredit ranking up its exposure to the German lender, about 28%, a lot of that through derivatives. And then the other bit, just to confuse us even more, Banco BPM is also involved in this because, remember, there was a bid for BPM from UniCredit, and BPM today out saying they need a bit of protection potentially from the government on that one. Then we'll check in on Astra. That one was declining as well as expected at the open. We're down 1.1% for AstraZeneca. News from the FT of potentially a decline in sales in China that hit overnight, and we're seeing Astra reacting to that one. Then we do have a bit of a write-down over in the paper and packaging spaces, doing all the glamorous sectors today. That was Stora Enso over in Helsinki, saying they're going to write down a number of items on their balance sheet on that one. I have to take my word for it, that one is lower today. And then in terms of ratings, Canal Plus, the French TV company, of course, is listed in London. There's Stora Enso. That was in the corner of my eye there, but it is down as expected. But in the French TV space, Canal Plus, where else would it be listed? But it's listed in London, just to add to the confusion on that one. But it has got its first new buy rating since we got the IPO from that yesterday, actually 2 days ago. So that one is rising. We've got a buy for that company. That one is gaining Canal Plus in London this morning.
OK, see, we do listings, do new money in the market. Joe, thank you very much. Joe Easton from our equities team with a briefing on all of those stocks that are on the move, from banks to cars to media to finished paper, all in the mix. Coming up on the programme, we will dive deeper into that banking story of this morning. Commerzbank shares rising as UniCredit hikes its stake to 28%. That's next, that being done through derivatives, asking if they can fully increase the stake above that 10% level, trying to get that permission. We'll dive deeper into the details. This is Bloomberg. Welcome back to the programme. Now, UniCredit has increased its holding in Commerzbank to about 28%, the move ratcheting up CEO Andrea Orcel's pursuit of the German lender. Let's get more with Bloomberg's Arno Schützer, who's in Frankfurt for us, covering this story. Arno, tell us more about what UniCredit, what Andrea Orcel are hoping to achieve here. Once again, we are told today that this is solely an investment, but we all know that there are other intentions behind it.
Yeah, well, basically, Orcel is telling the world today that he is still serious about this his Commerzbank potential deal. When he bought or when he made an offer for Italian bank Banco BPM a couple of days ago, he said that the probability of actually doing Commerzbank as well has become lower, although not zero. And with this deal today, he definitely says, OK, I still mean it. I still want to go for Commerzbank.
What's the pushback, though, Arno? And is money part of that, given that not only is Commerzbank one of the assets that he's hunting for, he has plenty, and you mentioned Banco BPM. Is there enough money for this? Is there pushback on this deal outside of the government as well?
Yeah, well, as you say, sort of the government has opposed this. There's an upcoming election in Germany, so government is likely to change, although the Conservative Party, which is ahead in the polls, is likely to win that, and they have said that they are also against a deal. So probably the political stance is not going to change much. There's been a lot of pushback from the Labour side. They've staged demonstrations and done a lot of internal meetings and everything. Yeah, so there is pushback. There's some pushback from clients as well, but on the other hand, sort of Germany is generally regarded as an overbanked country, so there's plenty of rivals who are ready to step in, and some of them, including Deutsche Bank, have said that they're already winning business.
Arno, we're going to leave it there. Great stuff. Thank you very much indeed. Arno Schützer joining us on what is happening in the European bank consolidation story, which feels it has many twists and turns still to come. Consolidation is a theme this morning. Shares in Nissan surging the most in 5 months, or in 5 decades. Bit of a longer time frame. This, as Bloomberg learns that the Japanese automaker is in talks to merge potentially with Honda. That's one of the options. Bloomberg's Craig Trudell joins us now. Why is this necessary?
I mean, I think you have to go back to when Carlos Ghosn was pushed out at Nissan, and you had an attempt on the part of the Japanese government and METI to really sort of, get their arms around this and find a sort of way forward for Nissan. It was clear that there was some real discomfort within the company with working with Renault and potentially a merger with Renault. Yep. And there was a lot of sort of nationalistic undertones to opposition to that. There was a natural sort of suitor within Japan in Honda. The problem was always that was a company that had a sort of fierce independent streak on its own. I think this was a matter of conflicting priorities on the government of wanting to actually do less of these cross shareholdings within Japan. I think eventually it got to the point where Nissan was so struggling and so underperforming that this is a matter of more necessity at this point, that they really need someone to step in and help, stop the bleeding.
So these are two businesses that had already said that they were cooperating with each other, working with each other on EVs, which is a large part of what car companies are working on these days. And now there's talk of broadening this cooperation and doing some sort of deal then. Does this tell us anything about the template for how you compete with the likes of Tesla, with the Chinese auto manufacturers? Consolidation has to be part of the story.
Maybe. I think it remains to be seen just how effective that's going to be in sort of, helping right what's wrong with some of these legacy companies, because we've seen here in Europe in Stellantis, a company that I wouldn't say necessarily is in the wilderness from an EV perspective, but from a broader state of the company is not performing well whatsoever. I do think that, in the end, you ultimately need to be much more competitive on costs and on product appeal to keep up with Tesla and BYD. And we've not really seen a sort of quote-unquote legacy car maker step up and really answer emphatically against these challenges. It is really difficult, and I do think that these companies also are still making quite a bit of money.
Isn't that company Toyota? This deal just flags to me just how well Toyota is doing. Toyota's delivered in so many ways as we work our way through this transition. But the key one is that they figured out that actually hybrids are an interim step maybe to that EV. Everybody else has kind of tried to leapfrog to EVs. They haven't done that. And they're producing cars now that people want to buy. Isn't that something maybe that others should mimic? Maybe it's less to do with kind of the other aspects of this story, but more actually just deliver a product that is usable by consumers. If you don't have the infrastructure, you need a hybrid.
I think that's a totally valid question, and I think the answer to that has maybe evolved just in the last couple of years, where I think a lot of the sort of consensus even just a couple of years ago was Toyota's missing the boat here too. They're sort of deliberately electing not to compete in the way of the future, and I think as an industry we're really sort of waking up to this reality of the buyer, the consumer is not where the analysts or where Elon Musk thought they were even just a few years ago. It absolutely is the case that Toyota made the right bet, and I do think that is something that Honda brings to the table that could be really helpful to Nissan. Nissan was not investing in hybrids. They did try to make the sort of leap to battery electric vehicles. That was not at all effective or successful. The Leaf was a total disappointment. And they've not been able to follow that up with any successful EVs. And so, Honda has some real strength with respect to hybrids that are more akin to the Prius. And I do think that that's something that could really help them, particularly in the U.S., where Nissan used to be, making quite a bit of money.
Craig, thank you very much. Thanks for the update. Craig Trudell, Bloomberg's Global Autos editor. Plenty of M&A to talk about then. M&A Wednesday, we'll work on a more alliterative title for that. We're looking at the banking sector, looking at the car sector, and all of that merger talk within both of those. We will move on to talk about the luxury sector, though, in a moment. Coming up, after a lacklustre year, European luxury stocks have been getting a boost from China. Is the floor in for some of the names in the luxury sector? We'll get some analysis of where the sector goes from here. Aurélie Husson-Dumutier, Luxury and Sporting Goods Equity Research Director at HSBC, joins us to talk us through the thinking on luxury stocks. This is Bloomberg. This is the opening trade, 30 minutes into today's session, and the picture looks fairly flat, really, entirely flat on the Stoxx 600. Lots of interesting stories from cars to banks under the surface, but at surface level, not much on the move. The FTSE 100 up 0.2% elsewhere. We see more modest gains. Let's pivot our attention to one sector that has been under pressure this year. Chinese commitments to growth since September may have lacked the detail that investors are looking for, but could they have put a floor under European luxury stocks? Here to discuss the sector sector. Aurélie Husson-de-Moutier, who's Luxury and Sporting Goods Equity Research Director at HSBC. Aurélie, nice of you to join us today on the programme. So do you think then that some of the commentary we've had out of China since September, has that succeeded in putting something of a floor under the luxury goods sector?
Well, thank you. Thank you very much, Anna, for inviting me again. Yes, indeed. We have turned positive on the luxury sector at HSBC at the beginning of December on the fact that we believe that Q3 sales growth was actually the trough, and that in Q4, even though the growth will not be extremely high, it shall be better than Q3. This is for mainly two reasons. First, as you mentioned, China stopped worsening, but also we have had some evidence that since the election, the American consumer trends is much better. So this gives us an idea of we should start seeing luxury growth trends to improve as of Q4.
Yes, so talk to me about the role that both of those markets are playing, Aurélie. I mean, it'll vary by business, I imagine, but which are you watching most carefully to get the next upside for the luxury sector? Is it going to come from China, or is it going to come from the US?
It's actually going to come from the US. The US has, during COVID years, the US consumer has become the most important luxury consumer in the world. And it's true that with the plans that some of the luxury brands have to expand with store openings in the US, plus the fact that we expect some volume growth, especially in that market, we expect 4% growth for the 2025 for the luxury sector, and we expect 7% coming from the US and from the US consumer.
Aurélie, it's Kriti in London. How much pricing power do these luxury brands have, specifically when it comes to the United States, given that so much of the earnings growth and the outperformance has come in the wealthiest parts of the American economy?
Well, yes, it's a fact that pricing has become an issue because during the COVID years, most of these brands have passed on massive price increases, roughly 54% between 2019 and the end of 2023. So pricing has become an issue for the aspirational consumers, and we expect in 2025 that the pricing component in the algorithm of growth will be limited. Around 1% to 2% maximum in the 4% growth that we expect.
But is the pricing power perhaps larger in other parts of the world, China, the Middle East, for example? Is there a little bit more room to maneuver there?
When it comes to pricing power, I think it's more or less the same in all the regions. What has been lacking probably for some of these brands in the sector is innovation. So they have sold the same product with a 54% increase versus 2019. So I would say that the pricing power is more or less in all regions. Clearly, the brands that are addressing the wealthiest part of the luxury consumer, such as Hermes, has performed better than some others. But in general, I would say that the pricing power is more or less the same in all regions.
Aurélie, good morning. It's Guy. What is the relationship between European luxury stocks and the US stock market? If the US stock market were to go down quite significantly, what would be the read across? What's the beta on European luxury and, say, the NASDAQ?
That is true that you have part of the consumption of luxury that is pretty much linked to the US stock market, but not only. Bitcoins can also be kind of an indicator. And generally, but it's when it comes to the luxury sector, I would say it's more the sense of confidence in the future that leads to sales reacceleration. And as consumers feel a bit safer about the future, they tend to spend more.
And what is the discount when it comes to Europe? These are mainly European companies. How big a discount do you think is applied simply because they are European?
Discount in terms of valuation, you mean?
Yeah, they exist in the CAC 40. And what we've tended to see on days when you've had French political turbulence or European political turbulence, you've seen these stocks going down. These are companies that have global footprints, yet they do seem to be impacted by European factors, and I'm wondering kind of how you think about that relationship going forward. We're going into another year potentially of political turbulence, of an uncertain future for Europe. Do I need to look through that when I think about these luxury names?
Yes, I think it's important to look, for the growth in the midterm for the luxury sector, and clearly current valuation shows that market is pricing the fact that in 2026 probably growth will return to historical average. When it comes to general macro factors affecting the share prices, I would say that what is coming from China has probably more of an impact than anything going into France, for example, or in Europe in general. It's definitely news coming from China and also now news coming from the US that are affecting the luxury share price performance much more.
Aurélie, would you describe what's going on in China as cyclical, or is there a structural element to it as well? Is there a rethink of interest, desire to own luxury goods coming from Europe, either due to just evolving tastes or politics, for example, or is that to overstate things? Is it all entirely cyclical?
Well, that's an excellent question, and it's probably the question that we receive the most from investors. At HSBC, we believe that the growth, that what is coming now from China is much more cyclical than structural, and that the growth in China will resume in the years to come. Probably not as soon as 2025, because we do not expect much growth coming from China and from the Chinese consumer. But we are very confident that the luxury sector will regain some traction with the Chinese probably as soon as 2026.
Aurélie, great stuff. Thank you very much indeed for your time this morning. We really, really appreciate it. We'll look forward to seeing you again next year. Aurélie Husson-de-Moutier, Luxury and Sporting Goods Equity Research Director, joining us from HSBC. Coming up, we need to turn our attention back to what is happening in the UK. UK inflation hits an 8-month high. What could that mean for the Bank of England's rate decision, which comes tomorrow? We will discuss that next. This is Bloomberg.
Welcome back to the opening trade. 41 minutes into Wednesday's session, and European equity markets looking, flat to positive as we wait for the Fed's rate decision later on today. In terms of things we have learned already this morning, UK inflation is one of those. It has risen to an 8-month high in the month of November, drifting further above the Bank of England's 2% target. The data supporting expectations that the central bank will hold rates at its final meeting of the year. Dan Hansen from Bloomberg Economics joins us now. Well, what a trip we've been on, a journey, I suppose, in the last 48 hours then, Dan, because yesterday you were here, we were talking about this really strong wage data,
yeah.
Gilt yields were up, the pound was up, and then today we unwind at least some of that market move and some of that expectation about next year.
Yeah, I mean, I think this morning it's just a bit of relief that we didn't get another massive upside surprise. So when we were putting together the forecast for this CPI release, I felt that there was a much bigger chance of an upside surprise than a downside surprise when you sort of put all the pieces together. We didn't get that. But obviously this morning I think there's just this relief effectively. I mean, there was a massive move yesterday on the wage data. And it's really interesting because I think if you look at how the bank has been behaving, it has been downplaying data surprises over the past 6 months. It's on this track, this gradual cutting track. And we're not in 2023 where they were buffeted by these huge shocks. And remember, they did this late cycle 50 basis point hike, which surprised us all. And then surprised with a pause. So I think, that move seemed enormous to me. And I think this morning they're just markets are just pretty relieved, to be honest with you.
On October the 3rd, the Governor of the Bank of England said that the bank could become more aggressive, quote,
on
interest rate cuts.
Yes.
How does that stand up to the test of time?
Not very well, does it?
No.
I mean, he clearly wasn't aware of the contents of Rachel Reeves' budget.
That's fair.
And that has clearly been the difference between him moving towards this sort of more aggressive stance and stepping back from that, which is he did at the Treasury Select Committee. He said, if you asked me 6 weeks ago, I was on the sort of side of the doves. You ask me now, I'm sort of a little bit more hawkish, a little bit more worried about structurally higher inflation in the UK.
Can we blame Rachel Reeves entirely for that? Or is it a misread of the situation more broadly?
I think if you look at how much the outlook has changed because of the budget, Okay. It's pretty material. And I think if you're looking at their forecast between August and November, all of the news was related to the budget. So I think it has had a pretty material impact on his thinking, yeah.
You talk about the makeup, though, of this inflation. I think it's pretty staggering that it's coming from goods as opposed to services. That's a stark difference from other countries that are seeing inflation, no?
Yeah, so this morning's data was all about this re-acceleration in goods inflation, or core goods inflation, which strips out some of the volatile stuff. And what's interesting about that is that has been the driver, at least this year, of the disinflation. So we started at 4, we got all the way down to 1.7 at one point. That is now unwinding as the level of prices sort of moves back to more normal and price growth rates move to more normal levels. So there's this interesting balance as we move next year and beyond in the medium term between services inflation, which is we talk about all the time, and that's the thing that the Bank of England's obsessed about, and goods inflation, and where services inflation needs to head. Because for me, I think services inflation probably needs to head quite a lot lower than a sort of long-term average analysis might tell you, not least because you're not having this big disinflationary impulse from China, which we had over the 2000s, and meant goods inflation fell, or goods prices, fell dramatically. So I think there's this interesting question about balance and how far services inflation needs to be pushed. Because we're at 5 at the moment. We probably need to get to at least 3, maybe even a bit below that. So we've got quite a way to go if you're going to get 2% inflation sustainably.
And so what does that mean for next year and the number of cuts we price in, if there's still that move downwards that we need to see in services inflation then, Dan?
Yeah, so the market, as we spoke about yesterday and this morning, the market's got, I think, 60 basis points now, so sort of torn between 2 and 3. I think they'll get to 4, maybe a touch below 4. So I think 75 or 100 is more likely. Our base case is 100.
Okay.
We've put out a note recently saying we don't think there's much space to go below that.
So not too held back by the stickiness of that services inflation then?
I think one of the things about UK, particularly services inflation, is that come April you get a re-indexation of all the a lot of the prices in the basket. And what you get, obviously that's related to inflation last year. So if inflation last year was lower than the year before that, you get this move lower. So I think we'll go from a sort of 4.5-5 world for services inflation to a 4% world. That's still not obviously 3% that I was just talking with Kriti, but I think that gives them a bit of space to take the foot off the brake and also think about the labour market as well.
The budget seems to have been positive for inflation and negative for growth. How does the Bank of England deal with the growth bit? If we end up in a stagflationary environment, does the bank have to lean on the inflationary side of the equation and not worry too much about the growth side of the equation?
So, direct answer to that question, yes. But in terms of the budget, I think there's been a lot of noise about the private sector. What's been missed is that there's an enormous...
Huge pay rises coming through, etc.
Exactly. There's an enormous amount on the government side that's going to come through in 2025. So the net impact of the budget was to loosen fiscal policy. So government will support growth, but what we're hearing sort of, in the media and the like, we're just getting a lot of news about the private sector, which obviously with this enormous rise in employer national insurance, it is clearly negative for the private sector. In terms of your point about growth versus inflation, yes, they will focus on the inflation side, but I think the challenge the UK has got is around supply, about productivity growth, about labour supply, and the fact that basically the economy can't grow that fast without stoking inflationary pressure. So we shouldn't really be too surprised that we have these what seem like very anemic growth rates, because that's all the economy can tolerate. Without stoking inflation. So I think, for me, the experience of the past 2 years is that the bank will focus very much on the inflation side, and the economy will just sort of be a sort of bystander in many ways as it sort of tries to bring inflation back to 2%.
All right, Dan Hansen from Bloomberg Economics walking us through the UK story. We thank you so much. Let's go to the other side of the Atlantic, where Bank of America CEO Brian Moynihan is warning that the American economy may not need too much stimulus. Moynihan speaking with Bloomberg about where he's seeing signs of strength, including in the consumer sector. Take a listen.
If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted, and a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a balance anything. It's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm and discussion, but everything's still out there until the policies get enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. So we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for a 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on it.
Bank of America CEO Brian Moynihan, they're ending his comments talking about that regulation. He also spoke about the idea that Donald Trump is going to bring in this era of deregulation, specifically around these capital requirement rules. And I think this is really important, because this is something that the likes of Elizabeth Warren, for example, has been pushing very aggressively in Congress. It's also one that's affecting the debate here in Europe, where if you start to see a kind of decrease in those requirements in the U.S., how do European banks actually compete? The EU, for example, and the European kind of regulators have said they're willing to bring it down to compete with it. Switzerland has taken a very different approach, saying, actually, we're going to be even more stringent to be more protectionist and more protective of our economy.
We've seen all the CEOs from the big banks in America on Capitol Hill arguing for lower regulation, not full implementation of some of these Basel III rules, haven't we? And with Trump coming in, I just wonder if it's already in the price. We see bank stocks was part of that Trump trade initially, wasn't it? An expectation of lower regulation.
The bit that may not be in the price is the fact that the banks could go out and lend more into the economy. And you could therefore see more liquidity, money being created effectively by the banks as they lend more money out into the economy, and that increases the overall liquidity pool. How do asset prices react to that could be quite interesting.
But there's hesitation in that, because it hasn't, those rules haven't triggered yet in the United States or in Europe. This is all talk at the moment. So if you're a bank, you just kind of hold on to that firepower in the case of you may need to hold on to it for these capital requirement ratios.
Maybe, maybe not. The mood music seems to be moving in their favour.
Yeah.
The music's getting brighter for the banks, it seems.
But this is where it puts Switzerland really into contrast, because it affects UBS, and UBS's share price has traded off of these headlines coming out of that. A lot of nerdiness around the regulation story, a lot of focus on Washington, and specifically today as well, we get the FOMC rate decision at 7 p.m. UK time. 30 minutes later, Chairman Jay Powell is going to be speaking at his press conference as well. And then I feel like this isn't the highlight of the day, but Micron earnings after the bell, and in the context of the major moves we've seen in Broadcom stock, this will be crucial as well, Guy.
Let's talk about the main event. It may be Micron a little bit later on. If you get a move like Broadcom, we saw the other day, could certainly be. Let's talk about what we get from the Fed today. The expectation is that we get a 25 bips. The forward-looking story is where the interest is going to lie. Are we going to go from 4 to 3 cuts next year, or are we going to go from 4 to 2 cuts next year, Valerie Teitel?
Yeah, that's a big question in terms of the dot plot. Just how many cuts will the Federal Reserve members pencil in? And could we even see a Federal Reserve member pencil in no cuts for next year? I think a lot of Powell's posturing in the press conference, just how cautious he seems, how often he used the words, let's move gradually on the pace of rate cuts, could get the market thinking that we could be witnessing the last cut of the cycle today. There could be a chance that this is a Fed going on pause in January for an extended amount of time. And I think his posturing and the way that he spins this message in the press conference will be closely watched. That we know that the market loves to jump ahead to the next conclusion. And I think the next conclusion for the market is just when the rate cutting cycle is going to come to an end.
Yes, we had a really interesting conversation with Chris Wiley earlier on about the market's mentality. It's still we're still in a mentality of rates coming down, and the point at which that switches and the market becomes really afraid that the next move is higher, then things really do change. With that in mind, will we get any clues today as to how the Fed is going to think about big policy changes that will come with the new president in the United States, whether that's around immigration, whether that's around tariffs? Of course, they don't want to factor anything, fully, deliberately, numerically into forecasts, I suppose, because they don't know what is being planned, but some sense of thinking about that. They'll be asked, won't they?
It would definitely be asked. Maybe we'll get hints of it in their projections. We do get their GDP projections for next year. Maybe a bit of that revising higher. He'll be asked on why, what drove that revision higher, and he could point to things such as you mentioned, the new economic policy under Trump. It'd be very interesting to see how he answers these questions. And he was asked very often, how does a Trump regime change the outlook for rates next year? And a lot of his discussion has been, look, even if we do get good things for economic growth, like deregulation, like the extension of these tax cuts, it could be until 2026 that we have to wait to see the boost to growth. So he could maybe push out any expectations that it affects their immediate thinking, maybe come to the January decision, and use words like we want to have a gradual approach, we want to tread carefully. They'll make the market assume that a Fed pause in January is on the cards.
The timing is really interesting because didn't we have this movie play out in March of 2019? We had extremely tight labor market, very low unemployment. The economy was doing great, and he installed an insurance rate cut instead as just that, insurance. And I'm wondering how much pushback he got then where he may not do it again this time.
Yeah, maybe we'll see that reflected in the dot plot, just how many members maybe don't see any rate cuts next year. Maybe some of them on the FOMC are more concerned about a resurgence in inflation. Perhaps, as you mentioned, the tightening of the labor market. If there is a big deportation of immigrants, perhaps that those metrics could mean that the Fed could be on an extended pause next year. I really think that dot plot is going to be very interesting. And remember, it drops at 7 alongside the rate decision. So we have a whole 30 minutes of the market on bated breath trying to digest the dot plot and what that means. And the 2025 dots, not even just where the median is, but how wide the dispersion could maybe reflect some division at the FOMC.
Really interesting. Lots to watch then in the dots, the forecast and the wording, the way the Powell responds to all the questions around the new presidency. Valerie, thank you so much for the analysis. Bloomberg's Valerie Teitel with a look ahead to the Fed. That is really the big market event of the day. We will be speaking with the U.S. Secretary of State, Anthony Blinken, today about developments in the Middle East, as well as in Ukraine and the foreign policy transition. In fact, this is coming up tomorrow under a second Trump administration. You can catch that, yes, tomorrow, 1:15 p.m. UK time. So stay with us for that. That is it for the opening trade. The Pulse is up next. They'll continue to count you down to the Fed. This is Bloomberg.